Hi there, Steven Sitkowski coming to you from my place in Utah. You can sort of tell, the way that I'm dressed. I'm going to go put on my big boy clothes here in a little bit and go teach a 3-hour investment class. By the way, this is kind of cool. Yesterday I finished recording my 3-day workshop content, and at some point I'll be offering that to the general public, people that want to learn about how to trade stocks and options and sort of some of the techniques that I teach on this YouTube channel. So stay tuned, that'll be coming out. Anyway, I wanted to show you a trade that I took today. Now, by the way, when I share with you a trade, it's simply for educational purposes. I'm not suggesting you run out and take this trade. I know nothing about your finances, so I'm acting in the capacity of an educator. And at this point, I am the leading educator on how to trade the financial markets. So I don't know how many hundreds of thousands of people I've had in front of me. But in any event, you get the idea. I want you to learn different techniques and to be able to see through the eyes of somebody who is rather experienced. So let's start. And those of you that have been with me for a while, you know the first place I always begin is by taking a look at what is happening in the overall market. So let's go to the chart. And we're going to take a look at the SPY. So the SPY is an ETF that is a proxy for the S&P 500. And as we pull this up, what do we see? Pretty obviously, still bullish, right? So if we connect the lows and we connect the highs, we're in a channel here, just a nice, beautiful, bullish channel. So we are going to favor more bullish trades. So with that, let me get rid of those lines. Let me show you the trade that I was looking at and why I took it. So it's Palo Alto Networks, and this is the chart. So you can sort of see what was happening. This thing was just going along swimmingly, and right here, boom. Now notice, that was an earnings announcement. So they disappointed. But the fundamentals on the company, as I look at this, right, and this sort of is a helpful indicator down here at the bottom. Basically, it shows me graphically what's going on up here in the upper left-hand corner. So the inner circle, they are buying. That's why it's green. The valuation on this is good. Fundamentals are good. All that is green. So it just looks like sort of a short-term blip to me. And then after the earnings announcement, right, stock has moved a little bit higher, and I would expect it and hope for it to kind of fill this gap. Why would I expect that? That's normally what typically happens. If I look at the other indicators, right, we sort of bounced off that 20. No real great momentum on the stochastic. The MACD is still red, but I'm seeing this stock set up a base, and so I think it's more likely to go higher than lower. So let me show you how I structured this trade. It's a little bit different. It is called a bull call spread. So basically what I did was I asked myself, okay, what price do I don't think this thing is likely to penetrate? So $250 a share. So what I did was I sold a call option at that level, and then I bought a call option with a strike price below it. In fact, at $240. Okay, so how do you set that trade up? So that's the rationale behind it. So if I go into options, I went out, March expiration gives me 99 days, and then I simply sold the 250. So let's just put in a -1. You can do as many contracts, obviously, as you would like. And then I bought the 240, the strike below it. So if you click on the trade button, and I'm not going to log back in. to my account. We'll just look at it. So the difference in the values, yeah, we can do this. So what I'm selling, you're going to get around $530 for it. What you're buying, you're going to pay around $830 for it. So the difference is about $3 a share, or $300 per contract. So if you did 5 contracts, right, it's about $1,500. If you did 10 contracts, it'd be about $3,000. If you just wanted to do one, that would be fine. So that's the rationale, again, that goes behind it. I'm looking at this thinking, you know, there is resistance at 250. So I bought the 240, sold the 250 for about $3 a share. And now I'm just sitting back hoping the price of this stock goes up. At what rate will I make money? Well, basically the delta of an option tells us how quick an option value moves up or down based on the $1 move in the price of the stock. So the deltas here, the differential, is only 11 cents. So on a $1 move, the first dollar move, I'd make 11 cents on a risk of $3. So about a little over 3%. Now what I'm hoping is that this stock climbs. I mean, if this stock ended up going from 226 and it got up around, well, let's see what we think is reasonable. Let me extend by 60 days on this chart, okay? So if I just extended sort of this current path, it could take it to about $250 a share. Is it going to do that? I don't know. I hope so. But even if it went to 240, the profit in this would probably be around 100% on my investment. So that's what I'm hoping for. That's why I did it. I will be seeing you soon. Until next time, God bless. Have an amazing day. I'm going to go get ready and teach a class. By the way, if you're not a subscriber, be sure and subscribe. We're up to 260 something subscribers, no advertising. So it's just word of mouth. And click on the notification bell, and then every time I post something new, you'll be notified just as soon as it hits YouTube. And if you want to do me a favor, if you like this and you know some other people might, tell them about it. It's always great. Let's just spread the word and make this a grassroots education movement. Okay, we'll talk to you soon. Bye for now.